Hello and welcome to this lesson. In this lesson, I'm going to provide you with an introductory framework for financial analysis. We will develop on this framework as we go forward with the program. So, in this lesson, we will try to understand the meaning of profitable growth. So, one of the questions that an analyst would always ask when they analyze a business is it growing profitably? So you need to use relevant frameworks and measurement to conduct this diagnosis, and this lesson will introduce you to these frameworks and measurements. What drives profitability of a business? So in this lesson, we will identify three main components that drive business profitability, and by the end of this lesson, you will learn and recall these three main components as you conduct the diagnosis. The financial objective of a business can be broadly defined as a profitable growth. Remember that businesses like to grow, but at the same time, they like to maintain their profitability. So, profitable growth refers to growth in which the return on equity is maintained or improved. So, it is important to maintain or improve the return on equity. Growth refers to growth in sales or revenues. And remember that there are certain underlying assumptions behind the use of these sales and revenues, which we will discuss in later lessons. So, how do we measure growth? Normally, growth is measured as growth in sales, which is current year sales minus previous year's sales, and then divide the whole thing by the previous year's sales and express it as a percentage. So, growth is always expressed as a percentage, as is profitability. So, return on equity is calculated as net income divided by shareholders' equity, and the whole thing is expressed as a percentage too. Shareholders' equity, you will remember, is paid up capital plus retained earnings. Thus, return on equity measures the return on funds invested by shareholders in this business. Now, return on equity can be decomposed into three components. The first one is margins, the second is efficiency, and the third is financial leverage. Each of these will be elaborated in subsequent lessons. So, what is margins? Margins refers to net income divided by sales. Net income is also called net profit. Now, if a company or a business sells $100 of products or services in a given time period, and then the net profit from this sale is about $5, you could say that the margin is 5%. Higher the margin, better will be the return on equity. The second component is efficiency. This is measured as sales by assets. This is usually expressed as a number. And as you can see, efficiency in finance refers to sales rather than production. Those of you who may be familiar with the engineering definition of efficiency would know that more you produce, more efficient you are. But in finance, it's not how much you produce, rather how much you sell that determines the efficiency. So as you can see, more the sales for a given level of investment in assets, higher will be the return on equity. The third component is called financial leverage. This is measured as assets divided by equity. Now, as you can see, if you have $100 of assets and that is matched by $40 of equity, then the rest of it has to come from debt. So, financial leverage measures the amount of debt finance. Now, in effect, what this asset by equity ratio tells you is that more the debt that is used by a company or business to finance its assets, higher will be the return on equity. So the three components of return on equity are net income divided by sales, sales divided by assets, and assets by equity. Now, if you multiply these three, it will come to net income divided by equity. So, in summary, we can say that growth is measured as a change, percentage change in revenue between one period and the other, and profitability is measured by the return on equity. So, if you map growth and profitability on two axes, that means growth on the x-axis and profitability on the y-axis, you can get a profile of a company. A company that has low profitability with growth is one where the sales are growing but the ROE is declining possibly. Whereas on the other hand, a company with high profitable growth would have experienced growth in sales, but at the same time, it would also have experienced growth in profitability, or at least have maintained its profitability as measured by ROE. So the growth and ROE map into the two-dimensional axis like this, and companies can fall anywhere in this space depending on how they are doing with growth and profitability. Thank you very much for your attention.